Actually, it's February, so it's the 2nd of the 2nd, 2022. That's just hit me now. Lots of twos on this date. With oil prices up a little bit this morning in Asia, nothing too crazy, but nonetheless still in a slightly upward motion. And the draw on inventories yesterday in the United States remind us that we are in a long period of declining inventories with a backwardated market, seeing that will continue. Let's kick off this morning with welcome everybody back, of course. Adi, Ole, well, lovely to see you. Happy New Year. We've seen Sarah, of course, this New Year at our forum a few weeks ago, but great to have you guys back at the table. Let's kick off with Adi Imsirovic, a Senior Research Fellow at the Oxford Institute for Energy Studies. My question to you, Adi, is how tight is this market? OPEC Plus meeting in a few hours, going to be sitting down and asking this exact question. Is this a tight market or an inflated market on geopolitics? Your thoughts?
Pretty straightforward. Hi, good morning, everyone, and good to be back again. Thank you very much. The market is pretty tight. There's no doubt about it. All the telltales that I tend to use when judging tight market are there. For example, you don't get much more sort of down to earth than physical dated Brent, for example. And dated Brent is trading in February about $2.50 almost above futures Brent, which just tells you how strong the physical market is. Other telltales that we look at are sort of quality differentials. Ekofisk, a sweet North Sea crude, trades about $3 over dated Brent. Premium, a Bonnie Light, about almost $2, $1.70, I think. Saharan blend, about $1.80. Primarily, you've noticed these are sweet crudes, and I think it's something we'll come back to later on. Brent Dubai differential, so-called EFS, is well over $5. Gas oil crack, gasoline crack are all looking very, very good. So when, as you rightly said, when you have this backwardation so strong at the front end, oil is not going to storage. In fact, any oil should be coming out of storage at this backwardation. And that's exactly what's happening. And we are now going well below the 5-year 14 to 19 average. So the market is fundamentally tight. And that coupled with some other things that we'll talk about later on, such as geopolitics and climate events in Texas and so on, are certainly making this market very, very strong.
Ole Hansen, Head of Commodity Strategy at Saxo Bank. Your thoughts on that tightness and there's the reports from Goldman Sachs overnight that they're sniffing a possible increase by OPEC Plus today that is more than the rollover 400,000 barrels per day per month increase. Your thoughts?
Well, it would be nice to get the 800,000 barrels that they were behind in December to get those back on the table. That obviously would help the situation quite a bit. So the tightness that we are most certainly seeing is right now due to OPEC Plus struggling to meet their own targets. So talking about an even higher targets when they can't even raise it to the 400 that the market is looking for, it's not really going to go down that particular well unless we see something from Saudi Arabia or doing something on their own, which they have done in the past if the prices were getting too out of whack. That could potentially be a surprise, but generally it is the lack of investment coming in. Some of the minor producers that they're really struggling to keep their production at the levels or return to the levels they came from. That's providing this support. So a surprise. Let's see what happens. The Saudi oil minister has been proven to be very good at that in recent months.
Sarah Akbar, Chairperson and CEO of Oilserve Kuwait and Non-Executive Director of Petrofac. Should the Prince, as Ole, the Saudi Energy Minister, step back from his declaration that we will not be eating other people's lunch? Should the big OPEC producers start eating other smaller members' lunch because they can't meet the supply expectation?
Good morning, Sean. I think, with this market and the heat that is in this market, they have to compensate for the barrels that others cannot produce. Now, some of this lack of production can be solved with investment. Some of it lack because they shut down and you have to reopen. So sometimes some of these wells actually do not come back to the same levels where they were before. So there is some technical issues behind this, but I believe it is capacity. So the only people that have real capacity to add to the market is Saudi and the UAE. And for those two countries for OPEC Plus to be credible, they have to fulfill their commitments to the market. And in order to do so, now it is the time for these two countries to add the barrels that are missing in order for this market to stabilize. So I think the opportunity is there. They can do it. And probably today they will make that decision somehow.
Sarah, do you think there is, by the idea of moving across that position of sort of filling the gaps, if you like, as the minister describes it, eating the other's lunch, which is kind of a negative sense of unneighborly behavior. Is there a risk to the union, the solidarity of this group, if that was to start to happen?
Well, you see, Sean, in their calculations, OPEC, they think there is a surplus in the market this year of about more than 1 million barrels. So they are still thinking that there will be surplus in 22. Now, with that kind of mentality, you cannot beat the short term across the average for the year. So in the short term, for the next 2-3 months, we are at that tight spot where we cannot fulfill the demands of the market. But in the same time, the market is super, demanding. And the demand is because of the winter, because of the tensions in Ukraine, because of various. So it's a short-term thing. And in the past, if you remember, some countries oversupplied for a period, and then they came back and they said, okay, we will cut down with that amount. So there is some kind of management in the process. And I think that management probably is what is needed at this tight spot, so that, we go over this cold winter and this time. So it's probably for 2-3 months where these, countries that have the capacity to add it to the market in order for this market to stabilize. So I'm not talking about the whole year, but probably a few months. And in the past, this month, I will produce more, you produce less, and then we will compensate. Mechanism was already there in the beginning, since the beginning. So
Adi, coming back to the earlier point again, the geopolitical risk premium in this oil price, has the market embedded this Russian crisis in Ukraine? Is it in the oil price, or we haven't seen anything yet, if indeed this was to go pear-shaped?
Yeah, I think last time we talked about this, Sean, I think last time I was on your program, I think it was Saturday, Sunday, it was Christoph was going on about it when really kind of the whole crisis blew up. Certainly a good chunk of that is in the market. I would say several dollars a barrel, sort of reflecting geopolitical premium. However, I don't think the market is still fully priced in potential conflict. And I think if we were to have some sort of conflict, obviously, whether it's limited or whatever, it would certainly have we would see oil prices going up substantially. Russia, we know, produces close to 10 million barrels a day, out of which they don't export much, actually, but they export about 4.5 million barrels, just short of 1 million east. So east probably wouldn't be affected very much, but we're still talking about, close to 4 million barrels in Europe. Particularly Europe would be affected, and the United States. United States actually have been increasing their Russian imports gradually over the last couple of years. So the impact would be great, but one also has to assume that any sanctions applied on Russia would almost certainly not involve energy, because it would be shooting oneself in the foot. But disruptions are possible, and people would, certainly take that into account. So yes, simple answer is I think we have several dollars premium already in there. If there was a conflict, I think we would probably have quite a few dollars more, especially in the current fundamentally tight market.
Andy, what is your thoughts on prices at this level as they are at the moment, that they move into the category of a national security threat to the United States because they diminish they bolster the Russian posture on the Russian-Ukraine issue, and they weaken or dilute the US options. But the price level at this moment, given the Russian crisis, otherwise it might be digestible, but given this crisis from the US position, this is now a threat and its allies should act accordingly.
Well, the high prices are, first of all, a threat to the US presidency because Biden is not looking good with these high prices. Secondly, Russia is looking very, very good because obviously these high prices suit Russia very much, including particularly gas prices, which are super high. And as we know already, Russia has very, very high foreign currency reserves, making it sort of a lot more comfortable with any further Western sanctions. So yes, these levels are not particularly comfortable for the West. And that brings to another point that we haven't mentioned for a while.
And maybe consequently not comfortable for the Gulf producers as well. It sort of puts them in a sticky spot.
Well, you know, the Gulf producers, as Sarah's already said, I mean, I think it's not an easy situation for anyone for OPEC to sit down and talk about, because we've had issues all over the place, from Ukraine to Libya. We have another issue, which I wanted to mention again, Iranian negotiations. Yesterday, I think there was some news that they were actually progressing very well, whatever that means. And
it's the progressing very well day press release.
That's right.
Tomorrow's will be the not so great progressing press release. Let's go to Ole. Ole, speaking of the markets absorbing the recent developments, have we already absorbed 5 rate rises? The equity market said, forget about it. I'm off to the races again. Oil's popping away. The Fed scares nobody. No teeth anymore. Your thoughts?
I think we have, because we even seen some of the. It's almost been a race now for the past week from banks to raise their expectations. We're seeing as high as 8 rate hike expectations this year now, so basically 1 at every meeting. So I think that's more or less cooked into the prices. But I think also what is the worry with this is, as Sarah also mentioned, that we may have this supply issues being front loaded here during the first few months, because as we move deeper into 22, will we see an impact of central banks starting to put the brakes on around the world, and what impact will that have on demand? So I think it makes perfect sense.
You would have to think 8 rate rises qualifies as slamming on the brakes, does it not? I mean, the markets don't think so, obviously, because equities are still running away. Companies are still making lots of money.
That's a big break. That is a big break, and I think, but the bond market is also telling us a story right now. We're seeing yield curves are flattening, basically indicating that even though we're seeing this expectation for higher rates, we're not seeing any much of a change in the long end of the market, and that could indicate the market's starting to worry about a so-called policy mistake, that they're putting the brakes on too fast into a slowing economy, and I think that's whether that's taken into consideration by OPEC Plus remains to be seen, but it could be also another reason why they would try to avoid to see oil reach this $100 mark that has increasingly been flouted in recent weeks, instead of trying to basically curb the price here around the 90 and massage it back down to the mid 80s, just to make sure that at least it's not the oil price that's itself that's killing demand.
Sarah, you mentioned earlier about where could new capacity come from. Well, your doorstep, the neutral zone, seems to be massively underperforming. The shared field between the Saudis and the Kuwaitis, where pre-disruption was up above 500,000 barrels in total, now struggling at 300 or something. Your thoughts on what is the outlook for recovery of the neutral zone production, and how quickly could that add barrels to the market, do you think?
Well, you know, and there are 2 parts to the neutral zone. There is the part in Kuwait and the part in 50. I think in both parts, what's lagging behind is investment. So there was no investment for a long time, and now it's time to put more money into this. If they do, and this meeting yesterday was actually a meeting to decide on the type of investments they will make. So this is basically heavy oil. It will take time for this oil to be produced. So you are not looking at quick recovery like before the end of this year. It will take a couple of years before you actually go back to those type of plateau that was before, like the 500,000 barrels. And in totality, I think the maximum they can add within a year or so is no more than 50,000 barrels. So it's not significant in the context of what we are talking about at this point in time for the oil industry. Now, going back to your point about the geopolitics, I wonder, Sean, what is the feeling in the UAE after these attacks on Abu Dhabi from these Houthis? Is this an insignificant matter, or does it have some impact?
Well, obviously what's published, I mean, the fact that it's publicly acknowledged, I think in itself is a kind of an indicator of potentially how serious it is. The UAE I think, a line has been crossed vis-a-vis the fact that it's somewhat unprecedented. But behind the scenes, is there different conversations happening that weren't happening a week ago? I don't know. But on the surface of it, the hotels are still full, the beaches are still dancing, and so there's no real change of any notable level in terms of today, life as usual. But I think in the back of everybody's mind, there is a realization that, something's changed here. This hasn't happened before. Is this a shot across the bow, as they say in the parlance, or is it, what exactly is this messaging? And if you take it in the context of the last 3 years, where we saw ships in the Gulf of Oman, a little here, a little there, a little this and that, and it's just part of that overall thing, that this is just another piece in that long form narrative, or is this some new chapter that changes? That I think is unknown. Your thoughts? Should it be a serious thing, do you think, or what does it look like from Kuwait?
No, we don't think it's a serious thing, because these are, they haven't so far really, other than the hit for Saudi a few years ago, or 2 years ago, 3 years ago, there hasn't been any serious hits anywhere, and neither in Saudi nor the UAE, no. So it is spiritual. It is not something that will impact. But I was thinking about a question. You saw that Qatar said the US asked the Qatar to step up in order to support any gas shortages in Europe in case there is. Now, the reality is the only country that can seriously impact any change in the energy picture in Europe is Iran, because as you know, the gas reserves of Iran are #1 in the world, and they are the serious competitor to the Russian gas, because there is already pipeline that goes through Turkey and that can be enhanced and that can go to Europe. So the alternative for Europe could be multiple source through pipeline, even not through LNG. So I think
none of that, I suppose, is going to come anytime soon. But Adi, I just wanted to get your views on that point of the spare capacity that OPEC Plus is not using because they don't want to steal each other's lunch. I'm wondering, there are some analysis saying, well, actually, they don't have the capacities to sustainably increase. Your thoughts on that spare capacity question and how it plays out through this year, where demand growth is forecast to be 3.5 million barrels or so a day for the year?
Well, this is a very difficult one, Sean. With Saudi spare capacity, what is Saudi spare capacity, and how do you define it? Definition is about capacity you can run probably at least 3 months flat out. That level, can Saudis run 12 million barrels flat out? Not so sure. So looking at that view, Saudi spare capacity exists at the front end right now. But if we assume additional demand growing over and above 2019 later in the year, then certainly we are reaching a level, I think, as soon as Q3 this year, where, you know, there's very little spare capacity to speak of. Having said that, you know, there is non-OPEC supplies that are certainly coming strong, particularly from Canada, from Brazil, and so on. So the point is that there's no shortage of oil, but the market is tight in terms of inventories. So, you know, the question mark is going back. I think the $50 million question is what Ole was originally talking about, and you asking him, is what the macro picture is really going to be. Because right now that macro picture is not very clear to me. Are we slamming the brakes? What is happening with the macro? I mean, certainly we are still in the risk on mode. And I think, personally, I think we are in a macro bubble at the moment. I was just looking this morning again, sort of Schiller seasonally adjusted index for equities in the US is about over 37, with a mean and median about 16, 17. So we're definitely in a bubble sort of environment. And oil is
I think
that macro picture.
The macro picture remains, Ole, one saturated in liquidity, of course, after multiple years of massive quantitative easing. Even so that the ExxonMobil are now in the quantitative easing business with a $10 billion buyback announced overnight, with record profits, highest ever by 25% or something like that. ExxonMobil could have said, I'm taking 10 billion and digging a hole in the ground of the Permian. That would have had an impact in softening oil prices a bit. In this record revenue window for oil majors, the choice to where to put this cash flow, it seems buyback rather than dig a hole.
Exactly, and that is exactly the core of the problem and the challenge we will be facing over the coming years. That the capex is not being increased, and some of it is being diverted because they basically need to look good in front of the politicians and the institution, the potential lending them the money. ESG is having an impact. We're seeing that in Europe with the gas prices, partly to blame on our over reliance on alternatives with no infrastructure to back it up. So that is the big question, and the big problem we will be facing, because the non-OPEC growth will be challenged by this, and also the risk that shale is one thing, because that is a relatively short life cycle, but the very long projects, when we just simply don't have the clarity about where oil demand will be in 5 to 10 years time, that is probably preventing them from digging that extra hole, as you say, and instead of choosing to make the stock price look good and hand some money back to the investors.
It must be a very difficult decision, because it seems like the less the capex, the bigger the profit. I mean, it's sort of a counterintuitive equation. The less money you spend, the more profit you make, and the price keeps going higher. Maybe that's the end game. Let's go to the survey question for today on this OPEC plus Goldman Sachs view. OPEC plus could announce a larger production hike than the 400,000. Do you agree with that Goldman outlook, or disagree in this day when OPEC are due to meet? It's a bit like will the Fed do a 50 basis point rate hike or a 25 basis one? Sarah, your thoughts, is this a time for OPEC plus to be bold, to sort of, I had one analyst tell me yesterday, they'll only want a 2-minute meeting and run away as quickly as possible and nobody pay attention because they don't want to get sucked into the Russia-Ukraine headlines. Or is this a moment to stand up and maybe be a bit bolder? Your thoughts?
I really don't know if OPEC is being bold. You know, the bold moments came from Saudi. They took the bold, steps over the last 2 years. It wasn't OPEC plus in totality. So if there is any bold moves, it will come from Saudi, and they are good at it. So,
do you think, Sarah, there is any, we've got this sort of emerging caught in the middle situation for the major Gulf OPEC producers. They're caught in the middle between the China, US fracture. They're now sort of caught a little bit in the middle of the US-Russia fracture. Can they walk a fine line between those two ongoing continuously, or is there any sense that deciding on a side will have to happen? What's your own sense?
No, they have to walk the fine line. You know, they have no choice. They can't. No, China is the biggest consumer, so they cannot, disturb that relationship. They are in this situation because they worked with Russia in order to create this OPEC plus momentum and so on. So they do have to work the fine, and they are really good at it now. So they learned their lessons from the past. They will not side with any party, and they will do their own thing.
Adi, we've seen in the price as it rises, the sort of gap between WTI and Brent narrowing now close to $1 rather than $3. What's your interpretation of that and the outlook for that?
Well, I mean, there's several reasons. One of them is that, as you've seen in the recent draws in the US, it's been very good demand within the United States itself. Secondly, you can call WTI now, if you wish, following gas, you can call it freedom barrels as well, because certainly if there was a conflict...
Next to freedom fries, we've got freedom barrels.
Yeah, exactly. So it would be freedom barrels basically associated as sort of available crude outside any sort of conflict zone. So that carries a bit of a premium as well. And WTI is very, very popular in Europe. We've seen a lot of WTI recently moved into Mediterranean and Northwest Europe, with the sweet barrels being at a premium. So yes, the market is certainly looking good, and WTI is certainly one of those sweet barrels that are certainly carrying a very, very high premium at the moment. Don't want to get technical about it, but that's also got to do with the price of gas and hydrogen, because it's quite expensive now to use hydrogen for desulfurization in refineries. It makes more sense to just buy sweet crude like Saharan blend, like Ekofisk and so on, and just run it. And if you actually see those differentials through the EFS, is partly it can be seen. Korea has just recently bought two VLCCs of 40s crude. China has been pretty much mopping up all the Libyan crude. So it's sweet crude that is currently carrying a big premium, and WTI is certainly one of those grades.
Yeah, there's increasing talk that the future crisis, if you like, is not on the quantity of crudes, it's on the qualities of crudes, where that is aligned with the demand. Let's go to the survey result and give Ole last word this morning. So agree, OPEC, Goldman Sachs, OPEC could announce a larger than production hike. This is an optimistic, bullish room. OPEC are going to put themselves on the headlines, OPEC plus, that is. Ole, the outlook in Europe, while has been obviously very stressed, the winter hasn't been that bad. There's no outages and so forth. How does that impact the outlook, do you think? We're nearly obviously moving towards the end of the winter, at least in terms of trading.
Well, as I think there's no doubt, unless we really have a major escalation now within the next few weeks, that we're going to get through this winter without a problem. The March-April gas spread has collapsed, so basically no worries about supplies on this winter. But that just will turn the attention to the next one, because we're once again facing a summer where we need a very strong rebuild of inventories in order to don't run into the same problem next year. And the question is really, where are those barrels going to come from? So we're not out of the woods yet, and that will continue also. I think and add that underlying support into the oil, as mentioned, through the switch, which will have an impact as well. So another tight year, but it would be interesting to see whether that surprise today, if that is delivered, because that most certainly would put the cat among the pigeons and create some volatility in the market.
On that point of European energy strategy, I mean, one of the things about this crisis we're hearing a lot about is Europe needs to get its house in order from an energy strategic energy point of view. We've had this event now a year ago. We've had it again this year. Another near miss, maybe the meteorite has pushed by. Is there lessons learned? Do you see that this is going to shift? I mean, we've got the US government out running around the world trying to get gas for Europe. It looks a little bit desperate.
It does, and the problem so far is that the politicians, they responded with the response they've come with for quite a while now, that we just need to have more alternative energy. That will solve the problem. It clearly won't, at least not for the coming years. So until we realize that we have become increasingly dependent on imports from just a couple of sources, and that LNG will continue to be an expensive source of import, then we will be facing higher fuel bills, and industry will be struggling to compete, and we as consumers will be staring at our bills with some discontent.
Yeah, it does seem that one needs some bold moves to get out in front of some of these challenges, including the Fed, who need to get out in front of rates or reclaiming some credibility in the market. I think a 0.5% increase is more likely than OPEC today moving beyond the 400,000. But perhaps it is a year in which reclaiming sort of authority or structural direction over some of these markets maybe needs a bold move. So let's see if there is a Saudi tool that comes out in a parallel. So OPEC, yeah, will keep doing the 400, but Saudi might do an extra little bit on the side, as they did on the downside when they cut an extra million, and OPEC Plus continued with its own plan. Let's see, only a few hours to tell. Decent interview today with Anas Al-Haji. I'm sure you all know him. Very useful insights, got a view of the world and the oil industry that's worth listening to, taking half an hour when you have it. That interview will be posted now on WhatsApp and on our Twitter handle shortly. All the best. Ole, thank you so much. As always, welcome back to the table. Adi as well. Sarah, great to have you. Have a great day. Catch up with you later. All the best.